In this lesson, we will look at the general introduction of financial management, which would cover the role of financial management, the traditional approach, and the modern approach, including the four decisions under the modern approach, such as financing decisions, investment decisions, dividend policy decisions, and liquidity decisions. We shall also look at the objective of financial management in terms of profit maximization and wealth maximization. This material covers the syllabus of various universities in India. This content will help you understand concepts of financial management, and it will also be helpful for your short answers and essay type questions. Financial management is generally referred to as the lifeblood of business. Typically, in a functional structure, there is personnel management, marketing management, production management, and financial management. Among these, financial management plays a very important role. Financial management also draws concepts heavily from economics and accounting. Now, what is financial management? Financial management consists of planning and controlling firms' resources. These resources are in terms of capital or cash. So financial management is about planning and controlling the capital of a firm. Financial management guides us on three aspects. Number one, how to raise funds. Number two, how to allocate funds. Number three, where to allocate funds. So financial management is concerned with the efficient use of important economic resources, namely capital funds. Capital is an important resource for a business. Without the capital, there is no marketing management, no operations management, etc. Therefore, if we mismanage funds, then the whole business fails. Often than not, the difference between a successful and an unsuccessful business is in the management of capital funds. Now let us understand the approaches taken in financial management. One is a traditional approach and other is a modern approach. The traditional approach was relevant up to 1950s, in which the concept of FM was restricted to only raising and administration of funds required for long-term assets. So for example, if we wanted to start a company, how would we raise funds? A. We would do internal funding, that is put in our money. B. We would ask friends, relatives and fools. C. We would approach banks, LIC, etc. D. We would also issue equity, that is sell shares of our company and raise funds. The traditional approach guides us on all these aspects. So in a nutshell, traditional approach guides us on the following aspects to raise funds. That is, it guides us in raising and administration of funds, in seeking support of institutions like banks, LIC, etc. It guides us on the types of securities to be issued, that is debt and equity. It guides us on legal and accounting relationships between firms and source of funds. Example, SEBI needs to be approached for permission to raise funds. Now in modern approach, it focuses on is raising funds as well as investment of funds. Modern approach deliberates on the total volume of funds to be raised, which determines the size of the organization. An example would be Jyoti Laboratories, which went public by issuing shares in capital market. The total volume of funds issued was rupees 500 crores. At the same time, Reliance Power's total volume of funds in their public offering was about 12,000 crores. So here we see two companies with diverse volume of funds. Number two, modern approach guides us on the type of financial assets to be issued, that is whether it should be debt or equity. Number three, modern approach guides us on the nature of assets to be acquired, that is investment of funds in various kinds of assets. So while in traditional approach we only looked at raising funds and its administration, in modern approach we look at raising funds as well as investment of these funds. Therefore, when we follow the modern approach, we have to make four types of decisions: financing decisions, investment decisions, dividend policy decisions, and liquidity decisions. So, in simple terms, how do we raise money for our company? How do we invest this money? How do we pay dividends? And how do we ensure we have enough liquid funds for day-to-day obligations? We will discuss each of these briefly. Now, financing decisions or capital structure decisions are decisions related to raising funds, which includes A. Volume of funds, that is, how much funds should be raised. B. Sources of funds, that is, should it be through equity capital, debt capital, money market, capital market, or a mix of these. And C. The types of security, that is, debt security or equity securities. This is called financial mix. Investment decisions, on the other hand, are decisions which involve capital expenditures. So when a company has raised funds, the total amount of funds raised has to be divided into fixed capital, that is, investments made in fixed assets, and working capital, that is, investments made in current assets. Looking at the earlier example of Reliance Capital Limited, where it raised a total capital of 12,000 crores, the management should now decide on how this amount needs to be invested. That is, they need to decide on what method to generate power, whether it is solar, tidal, or wind energy. Once that is decided, the management looks at the capital budgeting to evaluate the fixed assets proposals and then invests in the infrastructure of the power generation project. These are capital expenses in buying capital assets. So investments in fixed assets is determined through capital budgeting, and the investments in current assets is determined through working capital management. While deciding on the investment decisions, two important facts are considered: evaluation of prospective profitability of new investments. Here we try evaluating the option through profitability techniques such as payback period, post-payback profitability, accounting rate of return, net present value, internal return rate, profitability index, etc. We shall look at these in detail in later lessons. The second aspect that is looked before deciding on the investment decision is the cutoff rate. Cutoff rate is similar to the pass marks in an examination. Let us say we borrow 10 lakhs at an interest rate of 10% per annum. Then the cutoff rate for this investment is 10%. That is, the business should yield at least 10% profit. If 11% is earned, then 10% is returned as interest and 1% is the margin. Therefore, firms will always do whatever it takes to earn the cutoff rate. What we saw so far was how capital structure would guide you to raise the capital and invest. Now, when the business starts earning profits after tax, that is, earnings after tax (EAT), a part of these earnings will be retained by the company. This is called retained earnings, while the rest would be shared with the shareholders. This is called the dividends. Success of a firm and its support from investors is dependent on its dividend policy. Firms must be in a position to pay competitive rate of dividend, to retain existing customers and attract new investors. There should also be stability and growth in dividend rates. For example, if 8% was the dividend declared last year, an investor would expect to receive 8% or higher this year too. The three decisions which we have seen so far, that is, financing decisions, investment decisions, and dividend decisions, are major chapters by itself. Although if a firm has sufficient capital assets, it would need enough liquid assets such as cash to carry out the day-to-day activities to meet current obligations. Managing availability of liquid assets is known as working capital management. It contains three broad areas: cash management, debtor management, and inventory management. Now that we have learned broadly about financial management, let us look into the objectives of financial management. It can be broadly classified into two parts: profit maximization and wealth maximization. In profit maximization, the primary focus of the business enterprise is considered to be in maximizing the profit. All decisions such as financing, investment, dividend, and liquidity are influenced by profit maximization. Profit maximization can be argued as a short term objective. In wealth maximization, the primary goal is to increase the wealth of the shareholders, that is, give the best returns to the shareholders and maximize their wealth and take care of their interests. All the decisions such as financing, investment, dividend, and liquidity are influenced by wealth maximization. This is considered as a long-term objective. Symbolically, it can be represented as wealth is equal to inflow minus cash outflow. The benefits of following profit maximization are: it is a rational objective irrespective of the sector. It focuses on optimum use of resources. It measures the success of a business and the social desirability. The benefits of wealth maximization are: it promotes interest of equity shareholders. It ensures growth of the firm since wealth maximization has a long-term perspective. It benefits all stakeholders, including the society. The other objectives of financial management are balanced asset structure, balanced current assets and fixed assets, liquidity, that is prompt payment to suppliers, bankers, interest payment on debentures, and prompt payment of salaries to employees, judicious planning of funds, financial discipline, and efficiency. The topics that we have seen in this lesson summarizes the introduction to financial management.